Shall we start?
Yes.
Okay. Good afternoon, everyone. The Monetary Policy Committee took note of an important change in the baseline inflation trajectory with respect to the June 2017 statement. This trajectory now incorporates the first round impact of the implementation of the house rent allowance award of the 7th CPC by the central government. Excluding the HRA impact, which will affect the CPI cumulatively, headline inflation would be a little above 4% by Q4, as against 4.5% inclusive of the HRA in the June statement. Another important development noted by the MPC is that inflation excluding food and fuel, which has hitherto been sticky, has fallen significantly over the past 3 months. These factors, along with the normal and well-distributed rainfall and the smooth rollout of the GST, opened up some space for monetary policy accommodation. Accordingly, the MPC decided by a vote of 4-2 to reduce the policy rate by 25 basis points. Recognizing, however, that inflation is expected to rise from the current lows over the rest of the year, the committee persevered with a neutral stance. With several factors contributing to uncertainty around the baseline inflation path, implementation of farm loan waivers, the after effects of the GST, the timing of implementation of salary and allowance revisions by the state governments, the MPC emphasized its commitment to keeping headline inflation close to 4% on a durable basis. While retaining the projection of real GVA growth for 2017-18 of 7.3%, same as the June 2017 forecast, the MPC noted that while the outlook for agriculture appears robust, underlying growth impulses in industry and services may be weakening slightly. Given corporate deleveraging and the retrenchment of investment demand. In this context, it was of the view that there is an urgent need to reinvigorate private investment, remove infrastructure bottlenecks, and provide a major thrust to the affordable housing program of the government. The government and the Reserve Bank are working in close coordination to resolve large stressed corporate borrowers and recapitalize public sector banks within the fiscal deficit target. Eventually, these efforts should help restart credit flows to productive sectors as demand revives. I'll now request Dr. Acharya to say a few words and then Mr. Vishwanathan.
Thank you, Governor. Good afternoon, everyone. As we've mentioned in the past and as Governor has just underscored, addressing the twin balance sheet problem remains the Reserve Bank's top priority at the moment. Investment slowdown in our assessment is significantly rooted in the resulting debt overhang problem from this twin balance sheet issues. With the cleanup on banks' NPAs currently underway, we are striving to meet in near future an important prerequisite for effective transmission of monetary policy, namely robust health of balance sheets in the financial and the real sectors. In order to supplement these efforts, let me mention 3 developmental steps that the RBI will be undertaking to improve financial intermediation in the economy going forward. 1, will be releasing in coming weeks the final guidelines for tri-party repo, which we hope will pave the way for a vibrant corporate bond borrowing and lending market, providing better liquidity and price discovery, reducing market cost of capital, and allowing access to non-bank finance for a greater number of borrowers in the economy. A thriving corporate bond market would in itself improve monetary policy transmission by creating a direct impact of interest rate changes on a bigger part of the real sector in the economy. Second, to improve transparency in credit markets and to facilitate better early intervention as well as risk-based counter-cyclical provisioning, the Reserve Bank has decided to put in place a high-level task force comprising experts and relevant stakeholders. This task force will evaluate the existing public and private infrastructure for credit information, assess any data gaps, study the best international practices, and provide a roadmap for the development of a comprehensive near real-time public credit registry for India. Let me stress that the objective is to improve not just the credit assessment by financial lenders, but also of the financial lenders themselves. Third, the experience with the marginal cost of funds-based lending rate or MCLR system introduced in April 16 for improving monetary transmission has not been entirely satisfactory, even though it has been an advance over the earlier base rate system. We have constituted an internal study group across several clusters to study the various aspects of this MCLR system and to explore whether linking of the bank lending rates could be made direct to market-determined benchmarks going forward. The group will submit the report by September 24th, 2017. One last point, the currency in circulation is showing early signs of normalization. There remains, however, much surplus liquidity in the system that the Reserve Bank has been managing. We remain in touch with the government to make our toolkit for this task more complete. In the meantime, we will continue with surplus liquidity management using instruments indicated in the April policy. Thank you.
Mr. Vishwanath.
I'll begin with the point which Dr. Acharya referred to on the credit registry. We have been taking progressively measures to improve the effectiveness of the credit information that is filed with the credit information companies. And these reforms started with requiring all the banks to report all the data to all the CIs, so that there is no fragmentation. Subsequently, we wanted them to dovetail the SHG data into the credit information companies. And now we are making it mandatory for the CICs to issue what is such a comprehensive credit information report, because they used to carry the reports in various subsets in the form of what you call industry, personnel, MFI, and things like that. And they used to only give information based on the particular area from where the demand is coming. Now we're seeing, irrespective of where the information is being sought by, the comprehensive report covering all the bureaus in which the information is kept should be provided to the credit information seekers, so that the quality of credit assessment is back. The second, of course, is again, Dr. Acharya referred to the improvements that we're looking at the MCLR and what to do going forward. But when we introduced the MCLR, we are also allowed the banks that were the existing borrowers are under the floating rate and the base rate system, they could move to the MCLR on mutually acceptable terms. But we find that the base rate is relatively more rigid. So we need to look at, because quite a few borrowers are still under the base rate system, so the monetary transmission is to that extent impacted. So we will look at how we can make the base rate a lot more responsive to changes in the cost of funds of banks, and that's something that we'll be exploring very shortly. And we'll then have discussions with the banks on this issue going forward. On the NPA front, as we know, we have taken substantial action after the Banking Regulation Amendment Ordinance was passed. As indicated in the press release of June 13, 2017, we have, on the basis of recommendation of the RBI, Internal Advisory Committee, directed banks to refer 12 cases for resolution in the IBC. All these 12 cases were referred by the banks to the IBC, under the IBC, and they are in the various stages in the NCLTs of the respective NCLTs, the respective benches. Of course, dealing with the stress tests is an ongoing process, and we're working on the next steps in this.
Okay. Thank you very much. Take a few questions now. Hindu Business Line. Use the mic, please. Thank you.
On the one hand, there is a liquidity overhang in the system. Yeah. So, do you think there was a need at all for you to cut the rates? And then you also have a situation where inflation could rise down the line, actually. Yeah.
Well, you know, we have been facing the challenge of a liquidity overhang for some time, and we are managing that. We are keeping the weighted average call rate within the policy corridor, reducing the width of that corridor is something that was part of that toolkit. And while our statement acknowledges that from the current lows, inflation is likely to rise, it is going to be about 4% by Q4. And given the factors that we have pointed out, that inflation excluding food and fuel has fallen significantly over the past 3 months. Once we exclude the impact of the HRA, which is one source of uncertainty, HRA from the central government side has now been taken care of, and including that in the projection still brings us close to 4%. And we had said that this was a statistical exercise, and therefore it's right for us to net that out. I think what we have done is taken a calibrated policy decision based on the outturns and our projections going forward, and we felt that a 25 basis point cut while keeping the stance neutral was something that we should be doing at this juncture. Mint.
Sir, hi, this is Alik from Mint newspaper. Was a rate cut in October under discussion in the MPC, because by then you would have got 2 more inflation prints, a GDP data, and a clearer picture on surplus liquidity in the banking system. Also, you are now taking measures to improve MCLR transmission. So why not October? Why September? Sorry.
Yeah, that's a good question. The data flow is, of course, these days continuous, and we did have the GDP numbers that were released a couple of months back. We also had 2 more data points regarding the inflation print itself, and encompassing the development since June, the normal monsoon, the smooth rollout of the GST, the inflation excluding food and fuel coming down. We thought that this was an opportune time to do a 25 basis point cut. Govardhan?
Good afternoon, Govardhan from the Economic Times. You mentioned about several factors contributing to uncertainty around this baseline inflation trajectory. Put this in the context of what Dr. Acharya mentioned in the minutes in the last meeting about a higher interest rate. So that appears to be called for a bigger buffer. So what is the kind of a buffer from now? Is it not 1.25 to 1.7, something bigger? So what is that you would be comfortable with, the positive real rates?
I think we are, I would say we are looking at the real rate as one of the drivers into the decision making. It's not the sole component. And it's best to look at the real rate more when you think things are steady rather than when things are actually have gone through a fair bit of uncertainty as we have over the last year. Nevertheless, I think if you take the 6% rate and you take our projected rate of slightly over 4%, I think we are talking about something maybe slightly in excess of the range that you are talking about. My own view, as I had stressed in the minutes last time, was that this is all right in a time when transmission is actually not necessarily guaranteed to work as well, given the structural issues of debt overhang that have been flagging. So I think we are just slightly outside of the range of 1.75%, and we are comfortable with that.
Hindu?
Now we have seen recently SBI. We have seen SBI has cut the savings bank rate, so clearly they are indicating that their margins are under pressure. So with this rate cut, do you expect really banks to transmit bank to follow you by cutting lending rates further?
The way to look at the transmission is to determine what has been the case since we started the easing cycle. And there are 2 or 3 things that are clear. One, that on new lending, the transmission has been much stronger, especially in those segments where there is a lot of competition. So, housing loans and personal loans, where the NBFCs also play a big part. Secondly, on the part of the loan portfolio that is tied up with on account of base rate and liabilities of a longer nature, the transmission has been slower. Given the liquidity conditions prevailing and that we have reduced policy rates by a substantial amount since the easing cycle started, I think there is scope for banks to reduce lending for those segments that so far they have not yet benefited to the full extent of our policy rate cuts. Cogensis.
Thank you, sir. Bijoy from Cogensis here. So this is effectively a 5-1 vote in favor of easing. It's not a 4-2. There is a lack of sync between the RBI members voting itself. From February, when there was a stance change to eventually having to cut your CPI inflation projections, and having a 5-1 vote in favor of a status quo last time, this is the 5-1 vote in favor of an easing. It's a sharp movement in the last 6 months. Do you think it shows that there is certain amount of dissonance and there are too many factors that are moving, which means that different people have different views even within the RBI?
Well, firstly, there is a reason why we put out the minutes, so that the individual members can give their specific reasons for their vote decision, and possibly to explain why they changed their minds from June. I think the resolution itself, on balance, very comfortably shows why we went for a 25 basis point cut compared to the status quo in June. We have had more data points, some uncertainty has been resolved, and the substantial reduction in inflation excluding food and fuel. So I think it's all explained. Bloomberg Quint.
From Bloomberg Quint. Question on in para 19, you talk about the fact that upside risk to inflation have either reduced or not materialized. And then you say you expect to maintain that projection of 4% by the end of Q4. Why did you not change your stance while cutting rates? And also, if you stay on this path towards 4%, should one assume that this is the extent of accommodation you think was possible? Only if we start to see further deceleration in inflation or quicker disinflation could we see further room open up for rate cuts?
Well, let me refer to paragraph 19, where we make it clear why we are sticking to the neutral stance. That given that the trajectory of inflation is expected to rise from the current lows, that is the main reason why we have been cautious enough to stick to the neutral stance, and therefore, there is nothing to explain in terms of why we have not changed the stance. The stance is exactly where it should be and what it was in June, and therefore I think it was a right call to make by a majority of 4-2. CNBC आवाज.
सर, जैसे कि डॉक्टर आचार्य ने कहा कि जो ट्रांसमिशन है वो एनपीए रेजोल्यूशन पे काफ़ी हद तक डिपेंड करता है। एक दौर में हमने 12 कंपनियों के सामने कार्यवाही शुरू होती हुई देखी है। क्या आगे कुछ और सिलेक्शन आप करेंगे, कुछ और नाम आप चुनेंगे उन कंपनियों का जिनसे रिकवरी की कार्यवाही बैंकों को प्रायोरिटी पे करनी चाहिए?
I request Mr. Vishwanathan.
I think I'll reply in English. I think I've stated in my opening statement that dealing with the stressed assets is an ongoing issue, and we are working on the next steps. And I think that answers your question. We're working on the next steps.
That's one question at a time, please. Lata?
So on liquidity, I mean, by when we have been, although we have a neutral policy, we have had a fairly accommodative liquidity. By when do you think that will be drained, if you can give a timetable? And because of this liquidity, do you worry that yields in some places have really fallen? Don't you worry about the credit quality of some NBFCs, some mutual funds, some CP yields have fallen to 6%? Is there a worry at all?
Yeah, I think this is a good question. We are certainly examining this very closely. I would make 3 points. One, we were clearly remonetizing, and we had to wait and assess when we think the system is actually reaching a stable level of currency in circulation. Like one way I think something is stable when it bounces around its level. And I think it's only recently that this has started happening. Otherwise, we've just been remonetizing at an increasing pace, and currency in circulation has been going up. So one, we had to give ourselves a certain amount of time to know whether the system is actually getting the currency that it requires. Two, having said that, as you know, we have been mopping up a lot of liquidity on 7, 14-day and 28-day variable rate reverse repos. We've also started conducting open market operations at a fairly, I would say, gradual pace of reasonable amounts. Our intent is not to actually destabilize or shock the markets in any way. Third, we will continue watching the currency in circulation numbers closely to get a sense of whether we are at now the right level. And if yes, that will give us a sense of assuming reasonable growth numbers where we might currency demand to be in, say, 6 months, 9 months, or 12 months time, and that will lead to our calibration of the liquidity, of the more durable liquidity operations like open market operations that we might have to do.
So credit quality, sir.
I think one question at a time. And BBC?
Thanks a lot, Governor. So you have mentioned over here in the 20th paragraph that the government needs to take steps to look at private investment, remove infrastructure bottlenecks, and if you even look at the recent data that's come out, whether it's industrial production, factory output, that has weakened. How big a concern is that, and how much did that really play a role in influencing this decision to go for a rate cut?
I think we have mentioned that we could have a stronger growth performance if some of these things are taken forward. In particular, removing infrastructure bottlenecks, finding measures to reinvigorate private investment, and provide a thrust to the affordable housing initiative of the government, which has the potential for very strong multiplier effects. And I think a fair number of pieces of the jigsaw in that context are already in place. There is one that we have, we are aware of, and which according to several stakeholders is coming in the way for speedier implementation, is the clearance of these projects on affordable housing at the state government level. I think we need a time-bound single window clearance if this very important initiative, which has the potential for very strong growth impulses going forward, to come into place. So, okay, that's it. Thank you.